Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 13th of December. I'm Daniel Lam, your host for the podcast. Besides the concerns about the Chinese economy and the performance of its equities, one of the FAQs that I've been getting during media interviews over the last few months was our views on Indian equities. It's quite natural to ask that question because Indian equities have been one of the star performers within EM because it is relatively less susceptible to the slowdown in the growth in China. It got additional attention this month because it hit its all-time high. Investors like the success of Prime Minister Modi's BJP in the recent state elections because this is likely to result in a continuity in policies, which has been favorable for the markets. For example, the replacement of complicated local taxes by a nationwide goods and services tax, and infrastructure development to improve efficiency and to create job opportunities. But the longer-term structural pluses are what differentiate Indian equities from other regions. Unlike many other major markets, its demographics is positive, with nearly 70% of India's 1.4 billion population in the working age bracket. This results in strong trend in domestic consumption. A staggering statistic is that India is projected to contribute around 40% to global middle-class consumption by 2050, a massive increase from the current 5%. However, as we all know as investors, there is no free lunch. Indian equities are not cheap, and valuation continues to be the key counterpoint against a more constructive view on Indian equities. The price-to-earnings ratio is now approaching that of US equities and is nearly double the ratio for the MSCI Emerging Markets Index. Historically, when Indian equities reach similar valuations over the last 30 years, periods of stagnation may follow. Now, technically, after the recent breakout, the Nifty index may trade sideways in the near term. It has been making new highs, but the relative strength index, i.e. the RSI, has been retracing mildly from a high level. From a technical perspective, this shows lessening strength to push the index higher. The turnover is also telling a similar story, where it is gradually coming off, again indicating potential fading strength in the short term for the index. It seems that the Nifty may pull back and test the lower gap around 20,300. And that could be an interesting level for investors to get involved. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.